Super is packed with incentives that can save you tax now to help fund your retirement later, but we can't always take advantage of those tax savings at the time. In this video, we'll look at a little known strategy that can help you to catch up on some of those unused contributions you were eligible for but didn't use in full at the time. Kate will walk us through how the carry forward contribution rules work, including examples so you can see how it's applied in the real world. If you find this guide useful, please remember to subscribe so you don't miss out when we publish a new video. Please remember this information is general in nature and doesn't take into account your own situation.
Let's talk about how you can use carry forward to contribute more than the usual concessional contributions cap in one financial year. If you've contributed less than the concessional cap in any of the last 5 financial years, and your total superannuation balance was less than $500,000 on the last 30th of June, then you're eligible to carry forward that unused cap space and contribute more than the annual cap this financial year. To check whether you're eligible and how much you have available to carry forward from previous years, you need to log into MyGov and have a look at the ATO linked service. Let's walk you through how that works. When you log into MyGov, this is the screen that you'll see. You can go across to the Australian Taxation Office and click on that to go into the ATO linked service. Once you're here, you can go to the Super section to see the details you need. It's under Information. You need to click on that and then click Carry Forward Concessional Contributions. You'll see this screen. Make sure you're looking at the correct financial year, and it will show you the amount of unused concessional contributions you have available to carry forward. You can see there it is indicating this person is eligible, and we have blacked it out for privacy, but on your personal screen it will show you the dollar figure of unused concessional contributions that are available for you for the current year. To take advantage of the carry forward measure, you make voluntary concessional contributions to super. And there are 2 ways to do that. You can use a salary sacrifice arrangement with your employer, or you can make a contribution from your bank account that you later claim as a tax deduction. To make a salary sacrifice arrangement, you allow your employer to deduct amounts from your income before your income tax has been calculated. That amount is then forwarded on to your superannuation fund pre-tax. To make a voluntary contribution you claim as a tax deduction, you can make 1 or more contributions throughout the financial year from your bank account and then notify your fund of the amount that you intend to claim as a deduction. Either way, the concessional contributions that you make and their future investment growth are taxed at only 15% in the superannuation system, and that's the benefit of making concessional contributions. If your income tax rate is higher than 15%, then the superannuation system represents a tax saving for you. Importantly, if you're a lower income earner, your tax saving may be small or there may be no saving at all. So it's very important to take your own personal circumstances into account. If you choose to make a salary sacrifice arrangement, the tax on your regular pay will be reduced and you'll be generating the benefit of any tax savings immediately from your next pay. If you choose to make a personal contribution and claim it as a tax deduction, you'll receive the tax benefit once you complete your tax return. Usually that's in the form of a tax refund. Importantly, there is additional tax on superannuation contributions for very high income earners. So if your total income plus your concessional contributions to super is more than $250,000 for the financial year, that additional tax will apply, and it is called Division 293 tax. That reduces the tax benefit of making contributions to super, but doesn't eliminate it entirely. Now to some frequently asked questions. The first is, how do I apply to use carry forward? And the great news is that you don't need to. If you contribute more than the annual cap in one financial year in concessional contributions, then the ATO will automatically check to see if you're eligible to use the carry forward measure. If you are, they will go ahead and apply that to your contributions automatically. There are no forms that you need to fill in. The second is, won't my super fund charge me some extra tax or reject my contributions when I go over the cap? A lot of people are concerned that this will happen, but the answer is no. It's not up to your superannuation fund to monitor whether you've exceeded the contribution cap and apply any additional taxes. That's something that the ATO takes care of, and your superannuation fund will accept any amount of concessional contributions from you, record those, and apply the normal 15% contribution tax. The last question is about retirees. So, if you are retired, can you withdraw superannuation to get below the $500,000 total super balance threshold and become eligible to use carry forward? Yes, you can. If you make a withdrawal and as a result your total super balance on the 30th of June is below $500,000, then you would be eligible to use carry forward in the following financial year if you have unused cap space available. Before doing that, it's really important to consider whether making a withdrawal to become eligible for this measure is something that's worthwhile for you, particularly considering whether you'll be able to recontribute all of the money that you've withdrawn to superannuation or not, in light of the contribution caps that do apply. So seek advice if you're going to do that one, but certainly the answer is yes, that is possible. Now I'd like to show you in practice how the carry forward of concessional contribution cap works. You can see here this individual has contributed $10,000 in concessional contributions every year for the last 5 financial years. If we look back at the previous contribution caps, we can work out how much unused space they have from each year. In the first 2 years, the contribution cap was $25,000, so they have unused space of $15,000. In the second 3 years, the contribution cap was $27,500, so they have $17,500 of unused space from each of those years. That brings their total unused cap space to $82,500, which means that in this current financial year, 2024-2025, they could contribute $112,500 in concessional contributions without exceeding their cap. That's made up of the standard $30,000 cap that applies to the current financial year, plus the unused concessional cap space they have from the previous 5 years. Going further, we can explore what would happen if this person contributes more than the standard $30,000 cap this financial year. Let's say they make a contribution of $65,000. That's our standard cap of $30,000 plus $35,000 that they're going to carry forward from the previous years. The ATO will look back at their past 5 years of contributions and use up the oldest cap space first. So they'll take $15,000 from 2019-20, another $15,000 from 2020-21, and the remaining $5,000 of additional contribution will be drawn from the 2021-22 year. Once all of that is done, the person still has remaining unused cap space of $47,500 that they can use in future financial years if they want to contribute more than the standard concessional cap. Now I'll show you some more detailed examples, including tax calculations. In our first, the individual earns $180,000 in salary. They have access to the standard $30,000 concessional contribution cap for the year and also have $30,000 in available carry forward from the previous 5 financial years. Their employer contributes $21,600 to their super account, which is 12% of their income. And they also have the ability then to make additional voluntary concessional contributions of $38,400 without exceeding the concessional cap, thanks to that carry forward that is available. If they go ahead and make that contribution, their income will reduce to $141,600 that they'll need to pay tax on. To work out the benefit, we can figure out how much income tax they would normally have paid on that $38,400 contribution versus what they pay to contribute to super, and the difference is the benefit. So they're in the 39% tax bracket, including the Medicare levy, and all of their contribution will come from income in that bracket. If they were reducing their taxable income below $135,000, it would be starting to enter the next bracket, and the calculation would be more complex. In this case, though, we simply need to multiply 39% by the contribution to generate the income tax saving, which is just under $15,000 less in income tax. We also have to account for the super contribution tax, which is 15% of the contribution, and that's $5,760. The net benefit then is the difference between the two, which is $9,216, that this person will be better off by putting that money into superannuation.
We hope you found this video useful. SuperGuide members have access to an extended version of this video, which includes case studies and demonstrates how to use free tools to calculate your own tax savings. SuperGuide members also have access to many other guides that help you boost your super, as well as plan for and prepare for a super retirement. Join SuperGuide today and get your super on track.